welcome. You're watching Informed Investor, brought to you in association with the National Stock Exchange. I am Sumera Abdi. Well, everyone who's ever been to a girls' lunch knows what happens there. So it's a smattering of talk that ranges from everything between politics and news to shopping, from the men in our lives to the ones who got kicked out along the way, and the quintessential mother-in-law features quite prominently. But this afternoon, it's going to be different. Today, we're meeting with a set of women, and with them, we'll be discussing how they can manage their money better. So let's go in. All right, hello ladies. Thanks so much for having us over for lunch, and thank you also for being a part of our journey that endeavors to actually create informed investors and help women manage their money better. So today we have Sharmila Joshi with us, who handles equity and is one of the foremost actually equity advisors that we have. And we also have with us Harshvardhan Roongta today, who will be able to handle everything regarding your personal investments. So let's get started. I know we've been speaking about a lot of questions that you have. So do you want to go first?
Hi, my name is Jennifer, and what I want to know is, Harshvardhan, maybe you can answer this. How do I transit, like from a saver to an investor? Because when I started earning, my parents would tell me save, but it's not so anymore. I got to see my money grow. So how do I make the transition?
Well, see, it's very simple, Jennifer. If we have to take an example. Okay, you have a certain portion coming in the form of your income. There is something that you're spending out of that income. Whatever you're left with is correctly identified by you, which is savings. Now the question arises, what do you do with that money? Anything that, if you park that money in any area which is productive in nature, which generates some kind of returns over it, would be termed investments. Okay. Now you can begin with, in a very simple manner. If you are managing to save an X amount of money, identify why do you want to invest. There has to be a goal that you have in mind. You would want to probably put it away for your children's education, for your own self. I mean, there would be something that you would be having in mind. Identify those goals first.
I think that the common misconception that we have is, when we are saying I'm a saver and I want to become an investor, precisely because of this thing that, somewhere women are very non-risk oriented. You don't want to lose money. You don't mind spending it on jewelry because we still see that as an investment. So the thing that has happened, I think, the shift that has happened in the last couple of years is that because of the way things are, I mean, we are also more in touch with the way inflation is, for instance. We know that things on the ground are costing more. So, at your parents' time, when they saved money and they got that bank interest rate, it was enough because, at that time inflation was also low. But now, because of the way things are, we need for the money that we are saving to make us more than at least what the inflation rate is. Which is why we need to shift out of that, the safer norms that we are known for, whatever, that saving that we've done, whether it's fixed deposit, whether it's, any NCD that they may have owned, or, putting it in the bank. And we need to look at other options of investment.
Okay, fabulous. Let's take the second question first.
I just want to know whether it's a better idea to, buy the SIPs in gold and silver, and what is the preferred thing, to buy it like a share, or to buy it physically and keep it with you in the long run?
What do you think, Sharmila?
If you want to invest in silver and gold purely from an investment perspective, then I think an SIP or an that ETF, you have a lot of gold and silver ETFs which are being traded. I think they make a far more sense because you're not seeing the gold physically. It's it's in your demat account. So when it goes up, you'll feel like selling it. You will treat it like any other investment where you're saying that if I made X amount of money on it, I'm willing to sell. But if you make an ornament of your choice, of your pattern, I don't think that you'll want to part with it unless things were really, really bad.
Yeah, but is it better to then buy shares, or is it better to buy gold and silver? I mean, the valuable.
Okay. They're two distinctively different asset classes. When you're buying shares, they are nothing to do with gold, and when you're buying gold, they have nothing to do with shares. Now, within gold, if I'm understanding your question correctly, it is within gold there are different ways you can own them. One is you can have it in the form of a gold coin or a gold bar in your hand. There is another form of owning gold, which is that it does not actually come into your hand, but it will be in an electronic form. Okay, they're called they're called exchange traded funds, ETFs. So what you're doing is you're actually buying gold without it coming into your hand physically, like how money is lying in your account, electronically it's in your bank account. Similarly, you would have gold lying in your demat account. Okay, so the price risk remains the same in both cases. Now there is a third form of owning gold, okay, which is in the form of an e-gold, okay, in which you can actually own gold in electronic form. Go and encash it. How you take cash out of your bank account? You can simply go and encash it in the form of physical gold in your hand.
And there's one more question that's coming to us. Go ahead.
Suppose I buy shares of a stock, whatever, any of the shares, Tata or Reliance or anybody. So after buying those shares, do I become a partner to their subsequent ventures?
In a simple word, yes, because I think when you buy shares, you're automatically buying a share of the company. So to that extent, because every company has a paid up equity capital, and when you buy a share, you get X amount of that. So it could be a very, very, as you said, 0.000 whatever percent of the company, but to that extent, you're an owner of the company. And so if you understand that, and I think some of you here are also, managing your own enterprise, then you will understand that even that is not without risk. Because just as you are facing risk in an everyday situation, in trying to manage your business or at work or whatever, similarly the company is going through its own trials and tribulations, and you are part of that. So the idea is that you should choose a company where you think that the prospects are going to be good going ahead. And when they talk of it, they say that when they are merging that company with itself, they are going to do it in a certain ratio. So they'll say, for every 2.5 shares that you hold in X company, you will get 1 share of this company. So suppose I have 25 shares of that company, then I'll get 10 shares of the other company that it's getting merged into. So my 25 shares will become 10 shares or something like that. So it all depends on what vehicle that company has done to whether it's an asset it's acquired and it's merging with itself, or it's buying it in a subsidiary, or things like that.
All right, on that note, let's take a very quick break. We'll be back in just a bit. Stay with Informed Investor. Welcome back. You're watching Informed Investor, and we're here in Mumbai with a set of women from various fields, and we're trying to help them resolve their investment queries. So we have a question here. Go ahead.
Hi, this is Abha here. I have a small query. We hear of this SIP investments and everything. We invest in an SIP for number of years, let's say 2 years, 3 years, and then later we stop investing in those companies. What happens to that money which we've already invested in SIP? Is it lost? Can we recover it?
Okay, Abha, systematic investment plan is that you're investing every month, quarter, weekly, whatever the duration that you invest. The amount that you have invested will remain intact. Okay, so whatever you have invested till that period is not going to be taken away from you, unlike, I believe your question is coming out of a fact that insurance companies, if you do not pay for 3 years, do not give anything back to you. So when you give money, when you invest into mutual funds, and if you invested for 2 years, at the end of 2 years, after 2 years, suppose if you stop making investments, there is no harm to the already at the amount that you've already invested. It will fluctuate. If it's into equities, it will fluctuate the way markets are performing. Okay, but whatever you've invested does not get completely forfeited.
Can I sell those?
Yes, you can. You can sell them again and recover what the market price is at the date of redemption.
And what about investment in commodities like copper? Copper is nowadays, if you see, if the copper is going up, the gold goes down.
Okay, now at this juncture, I would advise that if you're at the basic level of investments, please do not go by hearsay, and somebody who's dealing in copper as a product, he may know invariably he may know what is happening with the copper prices, demand, supply, what is the international trend with copper prices. So he may be in a better position to take a call. So if you're not from that industry, at this juncture, please avoid it.
We'll come back to you. You had a question, right?
Well, my question is very basic. I know I have to invest, but I'm too lazy. I don't want to follow the share market, the chart, what is infra and all those things I don't understand. I don't even want to open my demat account, right? So is there anyone who can, help me with this, kind of hold my hand and take me through this process?
So I think, as we've been discussing, one of the easiest things for you to do if you really want to start investing in equity is to do an SIP. So suppose the Nifty today is at 5100. So, you start with doing an SIP when Nifty is 5100. Next month, let's assume markets are bad and in August markets go down to 5,000. Nifty goes down to 5,000. So you'll have put in money at 5,000. Then they go up again. So you'll have put in money. So what I'm trying to say is that over a period of time, your risk will get, it averages out. So it's very easy. It's for somebody like what you're saying. You want to invest, you want to start, but you just want to test the water. So this is a good way. Start with a small amount. Start with an SIP. Choose a good fund. Do that much work. Choose. Go through some literature and see which are the funds which are performing well. CNBC regularly talks to fund managers and they do personal finance queries. So you'll get a very good idea that which are the good funds at that point in time. Do an SIP in those funds. And just test the water for 6-7 months, and then you'll soon know that how your investments have done, and then maybe you'll feel more adventurous and take the next step and do some actual investment in equity or in any other instrument. But there is no getting away from doing the know your client and the demat form. You have to go through that process, and then just start with a simple SIP.
I want to just add to that question. Once they select a fund house, would you advise it for someone who's just starting out, perhaps just go with an index fund and then experiment with sector funds or mid-cap or smaller cap funds?
Absolutely. I think index fund is a very good idea, because then what you're doing is that you don't really need to then even study anything further. If you are, as I'm saying, if you put in a Nifty SIP in a fund that's tracking the Nifty, then what it simply means is that if the Nifty goes up, your fund will be doing well. If the Nifty is down, your fund will be doing badly. But if it's an SIP, again your average will be, you'll be averaging. Then as I'm saying, if you get a good feeling over a period of time, you can actually choose the times you want to invest.
All right, you have a question.
Hi, I'm Chetty, and I haven't been investing. My husband invests for me, but I'm very encouraged after hearing all this. Is there certain paraphernalia or research paraphernalia for beginners like me to go through before I actually decide that, okay, this is how I should start with small steps? So do you have certain basic things that we should read about, or certain things that we should go through?
Well, the best way is to realize that you need to invest. The moment you realize you need to invest, you will search for answers. There is, in fact, at this juncture, there is information explosion. I mean, if you want to search for something, you'll have 10 answers. So the idea is, once you're convinced that you need to invest, you will get to your answer somehow.
That's the problem, that there's an information explosion. So many a times they may confuse the person may scare me because I may click on something and there's so much information and I'm a beginner. I may just switch it off and say, it's not for me.
That's the point I was coming to also, Sharmila, is that when someone starts investing, and a mutual fund is easier perhaps to decide, because you can just see the 5-year returns or the 10-year returns, and it's simple maths to see which is bigger. But as far as equities are concerned, what would be the 3 or 4 things that they should study? Like, would it be if you say the fundamentals of a company, what should they be looking out for in those fundamentals?
Actually, even before you start at company, I think 2-3 things that are very easy to do and may not sound very sexy, because I'm saying you have to read or whatever, is that you can really start by reading newspapers and then correlating them with things that are happening around you. So suppose, for instance, you were to read that petrol prices are going up. So what is the implication for the companies which are oil marketing companies? So what's the implication for a BPCL? What's the implication for an HPCL? So you start going beyond what's in the headline. And I think that's the start to investment. And as you said, there's so much information around. I think the NSE website is brilliant. They have so much information on it. Any company that you want, any amount of information is available. Any transaction that you do, you can track it down on the NSE website. The money control site is brilliant. There's so much information. It's hard to imagine the amount of information that they have. Any of the newspapers, any of the business newspapers that we have, they have so many interesting stories on a daily basis. I mean, I think that every day there is a stock that you can go out and buy. There are 10 stocks that you can go and buy every day, literally. But you must just be able to spot them, and you must be able to spot the right stock at the right price. That's what the game is for us.
All right, let's take a very quick break. We'll be back in just a bit. On the other side, we'll tell you what makes a good portfolio. Stay with Informed Investor. Welcome back. You're watching Informed Investor. So far, we've been talking about various kinds of investments, but how do they all come together? What makes an ideal portfolio? We get a lot of queries on our website, moneycontrol.com, and today Harshvardhan has been kind enough to select one of those queries, which was in dire need of repair, and he's going to tell us how it can be rectified. Harshvardhan.
Okay, so we've picked this case of one Mr. Bibhuti from Bangalore. He wants about 50 lakh of rupees after 17 years for his kids' education, and he needs about 5 crore of rupees after 29 years for his own retirement. And he's also started making certain investments for this particular purpose. He's got investments into shares, he's got money invested into mutual funds also, he's got loans, he's got property, he's got all other assets. Now what do we notice here is that he's investing about 21,000 rupees into equity mutual funds, which has been mapped for his retirement. Now this money he's putting aside every month so that he accumulates 5 crores of rupees at the end of 29 years, which will take care of his retirement after he stops working. And he's investing about 3,000 rupees every month already for his kids' education. Now the good point that we see in this portfolio is, as I said, that he's got assets very clearly mapped for his goal. So if he's kept one piggy box, which is going to be used only for his retirement, and he's dedicatedly putting money into that box, very unlikely that he will break it in between. Right? He's got another piggy box in which he is putting money only for his child's education. So very unlikely that if he needs to go for a holiday, he will break into that and use it. So that's a very good habit that an investor should form, to specifically dedicate assets for a particular goal. So that is what I see in this portfolio. Second point is, he's got long-term view. He's got 29 years and 17 years from now to plan for something, and for which he's already started. So another good point is that he's got power of compounding to his side. Now let me give you this calculation. What is power of compounding? Now for 29 years, if he continues to make this investment of 21,000 into equity mutual funds, equities have a reasonably good track record of giving about a 14% long-term returns. So if I take a 14% compounded rate, his corpus at the end of 29 years by investing 21,000 every month is going to be 9.8 crores. That's the power of compounding. Now he clearly needs only 5 crores of rupees, so he's well in place to fund for his retirement. Now he has a child's education to provide for which he has 17 years, and he's investing 3,000 rupees. So if I take the same compounding factor, it works out to be about 25 lakhs. Now here is where he's falling slightly short, because he has plans to fund for 50 lakhs, but he's accumulating only 25 lakhs. So what is a solution that he can take is that he simply needs to, he's investing probably way too much for his retirement because he's overshooting that now. So what we could suggest to him is that dedicate another 3,000 rupees out of your retirement corpus, remove from one box and put into the other. So that becomes 50 lakhs at the end of 17 years. So his corpus at retirement will reduce just by some amount, and it will be about 8 crores and 40 lakhs, which is still above his targeted corpus. And on the other hand, he will be able to accumulate that kind of money which he requires for his kids' education. Had he started doing this just 5 years later, the retirement corpus would have reduced to about 4 crores and 80 lakhs. It would have become almost half. So the good part is that he started early. Same applies to all of you here. If there is anything that you need to save for, you need to start early. The power of compounding works really, it's really magical to see power of compounding work to your favor. So that's probably what you can take when you leave from this forum here.
All right, fabulous. Thank you so much for that, and thank you so much, Sharmila, for being here today. Thanks so much, Harshvardhan. Always a pleasure to have you at our shows, and thank you so much, ladies, for being a part of our afternoon. It was great meeting you, and I hope that we've been of some help. And thanks so much for watching. Also, do remember to keep sending us your questions and comments. We'll see you here next week.